joining us on Crash Course. This is only a course that's going to happen once. First, I'd like to summarize a little bit of the things and events that I think will happen, and then we're going to review the different areas of investment. Let's dive in. So we all know that the dollar loses value every year by the inflation of 2% at least. If it loses more, the Fed tries to do something, interest rate cuts or stimulus, to bring that back down. So in 1900, a dollar bill was true value. Today, it would have to be $31 to equal the true value of 1900's dollar. A dollar today compared to the 1900 only buys 3.2% or 3 cents. So you'd have to sit here and say, hold on, something's wrong with this system. Why does the dollar keep losing value? Even to now, we're only at 3 cents. How much lower can the dollar lose the value to? At what point will the dollar become negative value? And we know that we lose value of the dollar by the US government printing more money. And so when we see things like this, global economy is worse than the World War II Great Depression. The only way to combat it is for governments to print more money. And that's why we have all this stimulus checks, which then makes things worse for the value of the dollar. So here's how things work. The United States government is a shell corporation. They go to the Fed and they ask for money. They borrow money against the receivables, the taxpayers of the United States. Then the IRS pulls that money from them and then puts it back into the reserve. Have you ever asked a question like during the bailout with GM or some of these other banks? They were supposed to make a profit. Where's that profit? Did it pay off some of the national debt? Are they using it to make roads? Nope. They just keep on signing more bills, which then devalues your dollar. I've never seen this national debt stop or slow down. And here's proof that your name is being signed to this debt. Over the last 60 years, we've seen GDP under 60%. Now that we are over that by double portion, it gives me grave concern. And knowing that we print money to save the US government, it really worries me when we have these 4 states potentially getting ready to go into bankruptcy. How much money are we going to have to print to save them? Because they can't print their own money. So California, Illinois, New York, Michigan, these are really big states with really big budgets. So if they go bankrupt, the U.S. government's going to have to pull them out, which means they're going to loan the money from the Fed to do that. Who's going to pay for it? You are. So if you understand that the U.S. government doesn't work for you, nor do they work for the government, they're an independent banking system, it would seem strange. It should shine a light on what they're doing is for the benefit of them, not for us. Like when they get back the rewards of our taxes, they then take that money and buy off the debt. So when you read articles like the Federal Reserve moves to buy corporate debt, really what they're doing is having those companies be indebted to that banking system. Benefit to them. It's not back to us for the economy. It's for them giving out more loans, which then enriches the Fed. Now, I don't know if you're aware or not, but they've already voted on digital dollar and it should be taking effect January 2021. So with that information, we're at February 1st and we haven't really seen anything extreme. That's why I think we're on the verge of something happening. And now what? I don't know. I don't know if this digital dollar is kind of based on cryptocurrency, right? Where they give an X amount of the US dollar value. I'm not sure what system is going to be created out of this. I just know change is coming. How much change? How fast? I'm not 100% sure. But some of the narrative's a little bit strange, right? Don't get into cryptocurrency. Stay away from that. Stay into your US dollar that has zero value. If you look at both of the systems, you say based on results, the dollar has done a terrible job. You would not invest into a company that lost 2% every year. Then if you look at Bitcoin has made over 450,000 times itself. Now that's an investment. In only 10 years, we're going to get into that. And the reason is I don't know how big this looks is because you have the IMF has the SDR making a basket of international currencies, US, Chinese, Japanese, British. So is there a bigger idea behind changing our currency into something that would be more like a world currency? It wouldn't be that hard because there is just a couple families that own 165 of the world banks. So that's 165 nations out of 195 nations have one system like ours where the government says, hey, we need this money, we're going to borrow it, and the taxpayers, the people, and the resources pay back that bank. For me, I know when looking at cryptocurrency versus the dollar seems really stable. We wouldn't want $100,000 in our bank account and for it to lose 30 or 40% like Bitcoin can in a week or two or a month. And so that's why we kind of look at Bitcoin as an investment, not a monetary value of money. actually exchanging. When the bank's only giving you 2% or less, you'd have to say that's strange, because over the time, again, from 8 cents up to $40,000, Bitcoin has well outshined any CD. For that matter, Bitcoin has well outshined any other stock investment. The other thing I'd have to say is, based on the two systems, we see that the dollar's going down in value, and if it did go down more in value, you have to think of any category that your assets are in, 401k, stocks, your house, anything that is valued with the US dollar. If that goes down, that means all of those assets depreciate based on the value of the dollar. We've seen that happen with Iran, Venezuela, Cuba, Iraq, huge deflation of the value of their currency. And so we have to watch the leaders and what they say around us and what could be the result of the thing that they're saying. Do they see something that they should be telling us, but they're not telling us, or are they? So in August, with Chairman Powell said that he was going to allow the inflation to adjust, meaning he was going to let it run higher than the 2% standard before doing anything to help smooth things out. Meaning if anything bad happens, that they're not going to immediately come in and save the day. But the economy is doing so much better now. The stock market's at all-time highs. But look at this article in October. Mortgage delinquencies reach a 20-year high. Do you know what that just said? That said it is higher delinquency than even our 08-09 financial crisis. This should be a huge concern. What does mortgage delinquency tell us? That people don't have that cash flow of money where they can pay these payments. What else do we see? U.S. credit card debt hits all-time high. Delinquencies rise. But here's the real problem. This was February before the pandemic happened. Meaning, even before the pandemic happened, people were having a hard time paying their payments. And now, needing to borrow money, what do you think's happening? Well, 6 months ago, they said that over 15,000 stores would be permanently closed. Yep, the new Yellow Pages says that nearly 100,000 businesses have been closed. And there's another 160,000 businesses that have indicated that they may close. Not to mention, there's been over 10,000 restaurants that's closed. Over 17%. Permanently closed. Why is all this important? Because of the debts that were supposed to be paid, the employees that were supposed to make the money, all of the things that keep cash flow moving. So now think about all of the banks that have invested into these businesses. These businesses no longer can pay back those loans. Where's the money going to come from? Bail out? Well, that's another thing that bothers me. Bail in. Why bank bail-ins will be the new bailouts passed in the Dodd-Frank law. Basically, the way I understand it is they don't want to have to print more money to pay out the banks who've loaned all these businesses the money out. What they're going to do is take the accounts that they have and exchange those accounts for shares of that company. Like Bank of America, Wells Fargo, they have stock shares and they can pull money out, which is bail in, using the money of the assets that are in their depository, hand you back shares of a company that's failing because they have all these bad loans, and they can use your assets to be able to manage their debt problem. I know it sounds crazy, but this is the way I read it. How do you read it? Now, another asset class that makes me worry. If we remember in 08, right, you had Lehman Brothers and you had some subprime loans, and those subprime loans tanked the whole entire market for years. 3 years, the market was tanked. It affected every industry. Now, I don't know anybody who had a subprime loan. Do you? And if I did, what was it, 1 out of 100? So how did such a small industry, out of all the conventional loans, all the business loans, everything else, such a small group of people tank the market so much? Well, they created a void. There was a hole where that debt needed to be paid off, and in large scales. So when I see all of the debt from all of the people who still owe money but had to close because of coronavirus, now you look over at the stock market and I'm seeing huge holes, right? A report came out that Tesla would take nearly 1,600 years to make the amount of money that the stock market has valued it at. Basically, the earnings that it makes every year would take it 1,600 years to pay back the share value of where Tesla is right now. To me, that's crazy overvalued. And what did we see in 08? Subprime loaning happening at the same time. We saw that real estate prices were really high. Do you also remember what happened? Lots of people were quitting their jobs and becoming contractors. I remember I was in a Home Depot line and the guy in front of me was on the telephone. He's like, "No, I don't work there anymore. I'm a contractor now." Everybody was in the housing business. was flipping homes, building homes, doing repairs. Everybody was in the housing industry. And it makes me worried now. Everybody's saying the same thing, but they're not in the housing industry. They're in the trading industry. Everybody's on Reddit looking at Wall Street Bets, seeing what the next stock is to buy. Here's the problem with that. Everybody's trying to bankrupt the brokers, but what's going to happen once they do? They're going to create a void, a hole of debt that needs to be paid back. That stock will go to nothing. But here's the other problem is now money has to come from other places to fill that hole. So just like Lehman Brothers was the scapegoat for the subprime mortgages, is Robinhood and Reddit and Wall Street Bets going to be the scapegoat for the market to crash? If you understand how financial systems work, it should open up your eyes of, holy moly, this isn't right. How long can this last? So with the banking system, they say, save for a rainy day. Put your money here and don't use the money. Well, why? Because they want to borrow against the money and make mortgages so they can make money. Or they say, we'll give you a little bit of return for a CD, but you can't touch it or we'll penalize you. Why? Because they want to borrow money against your money. Well, now you have all of these online brokerages firms. Why? Because they take the stock shares that used to be on paper that you would hold at your house as currency value that you could use as monetary value. You could pay someone or you could be paid with those stock shares because it has value. Now you put it into a brokerage firm. Why? Because they can borrow against those positions. If you don't have covered calls on your positions, you know they can use them. So when you sign up for a brokerage firm, did you read that long agreement? Basically in there, it says that they can assign your shares to somebody else to use if you're not using them properly. Well, if you don't believe me, then just Google in, do brokers borrow stock shares? Here you go. They can and they do. It's extra money for them. So they're able to allow the brokerage firms to use those shares by shorting them, even though you own them, which then you'd say that's a conflict of interest. You want them to go up. Why are they allowing access to somebody else to short the very shares that you want to go up? And that's why Wall Street Bets is so furious about this. And rightly so. The system's broken. You want me to prove the point of why I know they're using shares improperly to make money is because think about it. Your stock brokerage is also covered by the FDIC. Why would you need to be covered by the FDIC? You're the one making the transactions, good or bad. But it's because they're borrowing the rights against the values of your dollar that you have in that brokerage firm. For instances like this. That's why brokerages always say day trading is risky. Buy and hold. Why do they want you to buy and hold? Because then they know that you're just basically letting those shares sit there for them to do other things with those shares. Why do they not want you to day trade? Because then you take away the value of the trading capability of them because you're using your money. So day trading's risky. Buy and hold because you don't want to lose your money when really they're using it the whole time. Why do you think they don't have education in high school to show you how to invest in the market? Because they want you to allot your money to a 401k, a mutual fund, something else so that they can control and use it, giving you back pennies on the dollar. All of these monetary systems are set up for the benefit of other people, not you. And they're leveraged. They are so leveraged to the max that I think it's ready to crack. So we all know that the dollar loses value every year by the inflation of 2% at least. So let me summarize. The dollar is losing value and has constantly lost value, and there's no end in sight. That's a failing system. The banking system has 20-year delinquency highs on credit cards and payments. This system is getting ready to fail and break. The stock market system, they're shorting against your shares. The evaluation of stocks is way too much. There's three big things wrapped around the US dollar that is getting ready to fall and fall hard. Now, based on that truth, I like cryptocurrency the best. Now, in all honesty, I am a trader, but for me, cryptocurrency is a buy and hold. Why? Because it's like a Picasso. They're not making any more. And every year, that Picasso goes up in value, but it does depend on where you buy that Picasso. If you buy it in a great economy, you're going to spend a premium price. If you try to sell that Picasso in a declining economy, then people aren't going to have the money to pay that premium price for that Picasso. And so then you might not get the full amount that you paid. But with cryptocurrency, if you buy at the pullback, then when the market goes up, you should be able to get great amount of value out of it. Now, for me, the cryptocurrency works a lot like a commodity, right? Gold, silver, one of these other things, because there's a limited amount of goods that are being traded. So meaning, like Picasso's, there's only so many of them. They should go up and up in value, or at least retain their value. So now let's look at some ideas about investing around what's going on. We're going to look at cryptocurrency, we're going to look at the stock market, and we're going to look at the dollar. Now, this is a standard business cycle. You can get it online by typing in stockmarketadvantage.com, standard business cycle. So right now, I feel like the economy begins to overheat. Next, bond prices begin to fall. We've seen that happen also. Commodity prices begin to rise, and we've seen that happen along with cryptocurrency, natural gas, oil, corn. Then inflation rises. And remember, we heard Powell say that he wasn't going to do anything when inflation rises. So this picture is indicating that we are at the top of the market getting ready for a fall. What happens at a fall is stock market prices fall, meaning get out because stocks are going lower. Once stocks go lower, commodity prices will hit an all-time high, meaning time to sell the commodities. And you don't start buying stocks again until you see bond prices rise. Once bond prices rise, you'll start looking at sectors like transport, technology, services, and capital goods to invest into, and then you'll hold those positions for years to come. Now, when picking what to invest in with cryptocurrency, keep in mind it's kind of like stock, but a little bit different. So a company has many different ways they can raise money. One of the ways goes to the bank and they can borrow money, they can do private investors, or they can go start an IPO, have the SEC regulate them, and then they can put their shares onto the market, and voila, they have value because they sold those shares, and then also they have maintained some of those shares. So as those shares go up in value, then they do better also. So they sell some, keep some. Same thing with cryptocurrency. Technology comes to the market and they need money to advance that technology, but they don't want to go through the SEC. They don't want to have shares of the company. So they maintain the core of the company, but offer cryptocurrency. That cryptocurrency is then sold and they make that initial money from that crypto being sold, but then they also maintain crypto. So as their company does better or that crypto does better, it goes up in value. And so it's a double whammy, just like creating shares in the stock market. Now, here's the difference. If the company like Ripple goes under, the shares of the cryptocurrency, XRP, will have value. Now, for me, if the Ripple company goes out of business, then basically I would be selling my XRP because I'd say that's a faulty thing. They're saying it should maintain and hold value, but we know that would be true. Why? Because value comes when people see that something is doing good. So if we see Ripple go out of business, we would say XRP is not a good coin to hold on to. Just like there's 20,000 different stocks that you can buy, there's a lot of different cryptocurrencies that you can buy. One of the ways I like to just filter through is top 50 cryptocurrencies. The other thing is when I'm buying something like Bitcoin, it's at 40,000. Is it really going to go to 1 million? Possibly. But do I want to have all of my money just in one thing? Or do I spread my money out? So for me, I like to spread my money out by 10. So I'm in cryptocurrency, but all of my cryptocurrency is divided up by 10 different cryptos. So again, I look at the list. You can Google top 50 cryptocurrencies and you'll get a long list. So if you're picking 10 to choose from, what do you usually look at when you're buying stock? Is it usually under $25 and then you're thinking of increasing in the value? Or do you just buy the best and the highest? There's lots of things to choose from, even some that are under $1, which this is up 24% today. That is a huge increase, especially when the stock market averages 8% a year. Here's how I divided up my money. I have Ethereum, Ripple, Polkadot, Cardano, Litecoin, Chainlink, Lumen, EOS. There's lots of other good ones. You just kind of have to research and see what people are thinking about the technology that's coming to market based on that cryptocurrency. Remember, crypto is like buying shares of a company, but you have no control of the company itself. You're able to invest, but not necessarily have a voter share of your investment. Now, when it comes to the stock market, market or reading the charts, this is Bitcoin futures, BTC. And we know that Bitcoin had a high right around 19,000, then fell off, making a low. When you make those highs and lows, you can make a range box just showing you the zone from high to low. Duplicate that range box up, and price comes into that next range, and then usually we'll see a little bit of resistance. So based on Bitcoin, because it was at 0, went to 40,000, I'm making a range box of that 0 to 40,000. If you were to duplicate that up, that would be on top of 40,000. 40,000 would have the next target be 80,000. Then if you did that again, your target after that would be 120. If you bought Bitcoin, my next target is 80 and then 120 and then 160, meaning it only gives you 100% every time you hit one of these targets. And it is at extreme value of money. That's one way to trade it. Every time you hit a high, scale some of your profit off the table. Maybe in the tune of 5%, depending if you need the money or not. If you're a long-term investor, you can hold it. The problem is, as price goes up, where's the target? So remember, when you're looking at a target that it's never been hit on Bitcoin alone, it's a $40,000 target every time. Now, if you have money in the stock market and you're looking for investing into Bitcoin, you can use the futures, you can use this here, BTSC, and it is not 100% linked to Bitcoin, although we've made some really good money, and it's right around 6 cents, meaning it's pretty cheap. Based off the information of Range Box, here you have highs around these 40-cent levels, and then the lows around nothing. So we think price would come back up into these highs, giving it a 600% increase. Now remember, if we took the Range Box and duplicated on top of here, that would give us another 40 cents higher at 80, just like Bitcoin. So when it goes up to 80 cents, you'd have another target. You could scale out. If it goes up to $1.20, you'd have another target, scale out. Every time it hits another 40-cent target, you could scale out 5%. Another way to invest into the stock market for Bitcoin or cryptocurrency is Grayscale. And they have a fund, and this fund has Bitcoin, Ethereum, Horizon, Litecoin, XRP, and others. So when you click on it, it comes up. It'll show you the ticker symbol right here, GBTC. Ethereum's is ETHE, and Litecoin, LTCN. And here's what the stocks look like. GBTC, which is pretty close to Bitcoin's true value. Right now, Bitcoin's around 35,000 and this is around $35. So we have highs. We broke out of those highs. So now we have a support level right around this $28 target would be duplicate this up. And then a further out target would just be duplicating it up again. But remember, this is kind of like a commodity. So once stocks hit an all-time low, Bitcoin should hit its all-time high value, meaning you should be then thinking of taking that money off the table for Bitcoin, pulling it out of the market so that you can buy stocks back into the market because they're extremely cheap. And we see here that right around the pandemic, what happened? Everybody started putting their money into this because it was a commodity hedge, and we've had an unbelievable run up. This will continue. Next is Ethereum. And again, this is an index. Right now, value is around $15 and Ethereum is around $1,500. First target would be back to these old highs around $65 from where we are right now, giving you a 300% increase. Why do I like that? Because look at this pullback right here. The red candles, and now we're making green. Red candles, then green. Every time you break a downward resistance line and start printing green candles, that's an entry. So right now is a good entry point. Litecoin, LTCN, is the newest of their ETFs. So you can see that we have resistance right here. We have these red candles printing. As soon as price comes above this, you can enter into the trade. What do we have here? We have an up run into a pullback coming down into the support level. So depending on your risk tolerance, you can buy here around $200. Targets would be based off the highs and lows, making a range box. And from the highs and lows, it's around $500. That would give you an upward target of around $1,000. Then what would you do? $1,500, $2,000, $2,500. Now, again, that's the stock market if you're trading cryptocurrency. But what happens if that goes up 100%, but the dollar depreciates in value? Your asset, because it's in the stock market, would also depreciate in value just because it's based on the US dollar. Now, if you're looking for a pure crypto play, where should you put your money? I use Kraken. I do have a link, and I am affiliated marketing with them. First thing is I like Kraken because they are a United States company. I've not had my money stolen like I did with Coinbase. It's very secure, and they have lots of options. You can even trade it from your phone, showing you charts. Now, here's the thing about Kraken is you can't just walk into the bank, talk to a teller, and say, hey, put my shares in. It does take time. There are things you have to do to verify your account, and it takes time to transfer the money there. But once the money's there, it's there. And again, then I would divide my money up into top 10 assets that you see for cryptocurrency. And if the dollar does fall, cryptocurrency value will hold as long as it's in crypto. As soon as you pull it back into the dollar, basically you have a deflated value. Now, here's the great thing. If the dollar does fall, but then as it comes back up, if you take your cryptocurrency that's gained value out of cryptocurrency, put it in a depreciated asset, the dollar, after it's fallen, then the dollar goes back up, you make a double whammy. So you're saving your money from deflating value in the dollar in cryptocurrency, because we're only talking about one-time event. The drama, a crash, a big event happens, you can take your money out of cryptocurrency where it was safe, then move it into the dollar asset, and hopefully it goes back up in value, giving you the same amount of returns. So now we're going to be leaving cryptocurrency. We're going to be talking about other commodities. But remember, these commodities could go up in value, but if something bad happens to the dollar where it depreciates, the value of your increase will also depreciate. So again, as the economy overheats, we're seeing this in real estate. We're seeing this in stocks. Bond prices start to fall. We're going to talk about that next. Commodity prices rise. And these are signaling that we're coming to the top of the market, getting ready for a big downturn. All right, the big boy everybody loves, /GC, which is gold futures. This is a 20-year, 1 week. First thing that we have is we have a cup and handle. Basically is there's the cup, here's the handle, and you get a breakout upward, and you could target it by the body of the cup right here. Or you could do what we talked about before, which is range box. Take from the highs to the lows, duplicating that up, and that will give you a target. So from these lows of 1,000 up into these highs of 2,000, gold target should be around 3,000. Now, could gold go higher? Of course, absolutely. And all you would do is just duplicate that $1,000 markup again. So it's going to go 3,000, 4,000, 5,000. And at those $1,000 marks, because they're whole numbers, people take profits at those full numbers. But here's the thing. If you're investing $2,000 to make 1,000, that's 50% return on your money. Now, the value of that asset depreciates, the dollar, you're making 50%, you're losing depreciation on the dollar. Is that really the best place to put your money? That's something for you to consider. Now, a way to amplify that gold return is to do an ETF that's 3 times the movement of standard gold. So if gold moves 1%, you move 3%. Another commodity to invest in is silver, AGQ, which is also a 3 times long. Here we can see in April, it made an all-time low, and since then it's been going up. We have a 10-year chart putting us back to $240. With all the news that Reddit's putting out with Wall Street bets and the short sellers in the silver market, I wonder if this would be a great place to get some huge increase. So last March, we had the lows, then we went up off those lows, making a flagpole, consolidating, making this pennant formation, and now breaking out. Great place to buy anywhere between this $40 and $60 range. Now, when I talked about flagpole right here, I was giving it a range of movement, which basically indicates it should have a breakout, and you could use that flagpole as a target. To make things easier, I just like to use the highs and lows. Duplicate that range box, and that gives you a target of around $130 over 150% profit, which would come back into that support level from 10 years ago. On to more commodities like corn. Remember what they said. They said when commodities rise, the market is getting ready to turn. So corn's been going up 80%. Where have we come into? We've come into some resistance right here. Might be a good time to buy as corn pulls back into maybe this $450 level. Buy it back to the upside. Corn's high side target would be around this $800 level, which would be the old highs back here. Another and the last of commodities is natural gas. We got these highs right around $6. Price right now is under $3. That gives you 100% profit to the upside. We just had a pullback with a breakout. Great place to buy. Now on to the next subject and place to buy that's giving us an indicator that the market's turning, bond prices. Your financial advisor will not tell you this information. They probably don't even know, but you're going to be shocked. If this is the center point of the market getting ready to have a huge turn, your financial advisor should be scaling you out of your equities. Today, I want to hone in on bond prices falling. And notice this happens before the turning point. So it's a leading indicator. Just like at the bottom, bond prices will rise, showing you that the market's getting ready to turn, go up. So when BND ETF is in a down channel, you wait to buy. As soon as it breaks above, you start buying stocks. When BND breaks that channel, you start selling your stocks. Like and follow so I can give you more information about bonds. So if bonds are a leading indicator of what the market's going to do, we should have some history, right? We should be able to see this real-time effect of what happens. Just like this chart, we can see that the bond market should fall or rise before the pivotal change. All right, here we are with BND on the left-hand side, the leading indicator, and you can see that the bottom was in at November 1st. At the same time, you can see the SPY continued to fall down all the way into January. The bond side was already up for 3 months before the S&P started to make the rotation. Here we are, BND in 2008. Bond made a bottom at October. SPY kept going down after October all the way till March, while the bond market was well off of its lows. This is a leading indicator. BND since August has been selling off. SPY since August has been going up. That is telling us SPY is setting up for a big sell-off. When we look at this sector cycle, it says bond prices are falling before the market starts to fall. So we should be able to see bond prices selling off. So the next is the broader market, the indices. And that's what we're worried about today is stock market prices fall. So we all know that price moves off support and resistance. So when we have the SPY against all-time resistance levels, we know that price can't maintain that level. It has to come back down. Just like our hope is once price comes down to support level, it moves off of that support and goes back up. With all of this major drama, I think the SPY will go down to at least 200 before finding any support. Now that was just based off this area right here. But once we widen this out and we come back and look all the way back to 2000, we see that there's a major support level right around this $160 mark, meaning over 50% off from the highs. If we hit major drama, this thing could go as low as $80. And I'm not trying to sell panic and fear here. I don't know what's going to happen. It seems like we're way overextended in all three areas, and I don't know that printing money would help, because that's the thing that's making the economy bad. So if we have a huge crisis, what's going to be the thing to save us to get out of the free fall? There's a couple ways to trade it. You can use UPRO or SPXU. Gives you that maximum benefit 3 times. UPRO, 10 years, 1 week. We can see it looks just like SPY, which is giving us a double top. And you can see we're already entering into some red bearish candlesticks. And naturally, our eye is drawn to this support level right around this $15. The thing about this is it's an $80 stock. So if you're buying puts, they're going to be more expensive. Now, this is SPXU, 10 year, 1 week. If you look, you say, this is crazy. It just keeps going down and down and down. And it's because the stock market keeps going up and up and up. This is the inverse. And so price is right around $30, which means you'd buy call options, and those call options would be less expensive than those put options. Now, you would just use these old same highs of 250. The concept works the same. Buy low, sell high, taking targets at around 250. Or use UPRO and take targets around $15. Either way, we're talking about a crash here. That's a huge move. So you don't have to put all of your money at risk. With using an option, you can use less than 5% of your whole portfolio in these positions. If they work out, you'll make phenomenal returns. If they don't work out, you didn't lose much to protect against the possibility. It's kind of like buying insurance for yourself, for health, or for your business. You spend money every year on your car, but you never get in an accident. This is the same way. We see a lot of risk and danger in the market, and so to spend 5% of the portfolio buying some puts or calls, depending on which way you like, is well worth it. What would happen if the market did collapse? And then you would see a lot of value. Now, some people like to go out of the money when they do options, and that would have to be on what you feel comfortable with. Obviously, if you want to buy a position like normal stock position, you would want to use SPXU. Why? Because it's $28 and you would hold it to that 250, which gives you a 10 times your money return. Then you don't have to pick the right month, the right week, the right year. You can just wait. A crash happens, you get that return. If crash doesn't happen, you still hold it and it loses a little value. Now on to the banks. There's an ETF that you can trade against the banks. So what happens is if the banks have that oh no moment, their values are going to start to go down. If you Google ETF database, they'll show you a long list of other ETFs to take looks at, like SQQQ. This is a 3x short on the QQQs, the NASDAQ. Huge amount of volume, and it's only around $13. Or bearish, like we are on the financial institutions, it's a 3x bear. So FAZ will go up in value by 3 times, has over 4 million in volume, and is only $7. Now it has lost 3.8% this year. And we know that bank stocks have gone up this year off the lows. But do you see this increase that happened back in March? It's 220% from the bottom to the highs, which would have gave you a way better return than placing puts on PNC, which would have yielded you 50% down, which if you would have placed call options on FAZ at a 220% move up, that would have really amplified those options. So in a wild crash scenario, if you're buying these around $650 and they go back up to these old highs of $80, that would be a huge 1,300% increase on your money. And here's the thing I just want to point out. Here's where price went to on just what the idea of a coronavirus would have on the impact of the world. Now we're seeing the results of that impact. We are seeing that people are in huge financial trouble. So based on bad news, we went up to $80. Now that we're seeing real life bad results happening around the world, will it produce an even graver move in the market? 80 is my first level on a crash. 160 is my second target. And you would want that kind of increase because if the dollar falls in value, you'd need something exponential to be able to replace the value that you're losing in the dollar. Now, the greatest thing about this is once you hit those highs, again, you can take that money, put it into cash. It's not going to be as worth as much, but you'll be able to turn that money over and start buying stock positions back to the long side. All of the commodities that are way overpriced, you'll be able to sell short. The indices, QQQ, SPY, Dow, you'll be able to buy and hold for the long term. You'll be able to buy companies and get dividends in. You'll be in control of your finances. But if you just leave your money in the market and then you get a crash, what's going to happen is all of those assets are going to be reduced. The value of the dollar will be reduced. That's holding that asset. It's a double whammy. This could be a terrible, terrible situation. Now, next, let's look at the dollar itself. This is the US dollar, bullish version, UUP. And if you look, we came into all-time highs right before the pandemic. And now what's happening? It's already been selling off this last year in the tune of over 16%. Did you know that? I'm a support and resistance trader. So when I see support, I buy. Well, guess what? Do you see where it came down, touched that support level, but now it broke lower? This is a clear indication that price is going to go down on the dollar. How low? I don't know, but my first target would probably be around these $21 level. Now, if you don't buy options, you can use UDN, which is the bearish ETF for the index. So as price goes down on the dollar, this ETF will go up. Where will it go up to? Well, we have these $30 levels up here. So if you're buying at $20, this will go up to $30 for the first target. Range box duplication, you could have a $40 target after this, giving you 100% to the upside. What else do we see? We see that right here is the lowest low, and over here is a shoulder. So what could we have is a head and shoulders pattern turning so that the market's getting that bottom base, getting ready to go up. Now, this is a good place to put some money because if the dollar falls, this will go up. And you can see that it's not a huge mover, meaning that even if we're 100% totally wrong and it goes down 10%, you're not going to lose a lot, right? But if a crash happens, you'll be able to gain and have some real stable consistency to your portfolio. And here's one of my favorite things to this scenario is UDN, the bearish ETF. You could do single call options all the way out to June or further. And when you're buying them, they're only 10 cents, meaning, again, it doesn't cost you much money to get into this scenario. It's well worth the insurance of protection of a market crash. Even the September call options are only 15 cents. Just if it went to at the money, that would be 80 cents. You realize what I just said? For 15 cents, you can control against a stock market crash, have 9 months of protection, and if it just goes to at the money, you would make 500% on the money that you invest into this call option. To me, that's what we call no-brainer, especially when it comes to major drama. I don't like major drama. I like to make sure I'm protected against it. I have umbrella insurance on my companies and on my houses and on everything because I don't like the effect of feeling I'm at risk. Look deeper into these situations that we explained today and find out for yourself what you can do and how you need to maneuver your portfolio to make sure that you're doing the best thing for you and your family for the future. And remember, once these commodities and these things go up, you can short them to the downside, making a double whammy on your money. At the end of the day, no matter what happens, be calm, cool, and collective and think about the process of what's best for you to do to ensure not only that you protect, don't lose money, but you can make some money. I don't think you need to be overly exaggerated and put all of your money into one thing, Bitcoin. Be well diversified, and the best of luck to you. I wish you nothing but success for you and your family for years to come. Stay tuned, plugged in to our channel to see any upcoming events or ideas or things that we're saying about how to maneuver as time comes. Thank you so much for joining us. I really appreciate you.